A wrap of the Wall Street close. Unrivaled access to key decision makers.
It's a very credible result.
Squawk Australia. You can't afford to miss it. Starts next Monday at 6 a.m. Only on Cnbc. First in business worldwide.
Friday morning, you're back with Squawk Box. Quick snapshot on how we're doing for markets that are up and running at this hour. Early Asia side, we've got Tokyo adding on to yesterday's 250 points in gains, 82 points ahead now, about 0.5% higher, 17,501 is where we're sitting on the Nikkei 225. The Kospi in Seoul, 1451, that is up 0.2%. Sydney still looking soggy though, down a tenth, 59.52. Our next guest says the problems that we've been seeing in the U.S. subprime mortgage market will affect the rest of the U.S. economy, and he expects the Fed to cut rates in the next 6 months. He also sees the U.S. economy heading into recession. The dreaded R word. Niku Horachi is managing director of K1 Fund Distribution. That's a hedge fund with about $500 million in assets. He joins me here in our studios. Nico, it's been a long time. Good to see you again. Good morning.
Good morning. Good to see you, Martin.
Let's get right down to it. You are calling the U.S. economy to go into recession later this year. Sounds very much like Mr. Greenspan. 30% chance. Do you think the odds are higher? And also, when is it going to go negative?
Well, I don't know if we think that the chances are higher, but we definitely see that the central bank would have to cut rates sometimes this year. We think they have rising concerns on the mortgage markets, on the weakening consumer spending, and other economic slowdown.
Okay, so it sounds as though you think, a lot of people have been telling us, the subprime mortgage problems, it's contained, it's fine, it's going to feel a little bit of hurt, but it's not going to spread to ultimately hit the consumer. You don't believe that?
No, we do not believe that. And we actually, as we saw the Fed coming out 2 days ago, since then we've seen the market soaring. Yeah. We believe this has been a relief rally. We actually think that investors was expecting the Fed to come out and have some show some concerns about the subprime markets, and they didn't. So we think they took this chance to buy stocks, equities. However, we think that we got one present chairman, Ben Bernanke, saying that the U.S. economy is on track. It's expanding, it's growing. However, we have seen Greenspan coming out, and not only on one occasion, on more occasions, saying that the subprime markets could spill over into other areas, especially the consumers.
But, that raises the question. It's Bernanke in the chair now, not Greenspan. Greenspan, of course, is the maestro, but he's not the one pulling the levers right now.
It's true, and that's a good point. Yeah. And we think that maybe Ben Bernanke has to watch his words a little more carefully, and we think that Greenspan, not sitting in office, he can play a little bit more with his words, and maybe actually warn the markets.
More transparency from him, then, you're saying, than from the Bernanke Fed. That's interesting. Okay, so recession, you think rate cuts 6 months out, that puts us around about third quarter or so for... What, just to trim 25 basis points down to 5 even?
Yes, exactly. I think we'll just go down 25 basis points. Okay. And we would like to refer this to the inverted yield curve. Now, we think, and this is also maybe what Mr. Greenspan is referring to, is that if we see usually if the investor puts down his money on the longer term, he should receive higher returns. But actually, since June last year, we have seen the 2-bond note. Are you not agreeing with me on that?
Well, you see, Gail G, I tell you what, bring up the 2s and 10s, the USTs if you could, because we were just talking about this earlier on in the show. Yesterday, overnight, what was interesting was the curve normalized for the first time in I don't know how long.
Since June last year,
and we've got some people saying that 3 months out, we could actually see it go even more normal. That is, the right-hand side steepen and the gap go to about 30 basis points. You don't agree, though?
Well, let's see. This is what's been happening overnight and in the last 2 days. We still think that it will go back. Yeah. We think that that investors are concerned about the Fed that has tightened too fast, and we think that they will expect a recession. So we think that the yield curve will go back.
To go back inverted is what you mean?
Yes, exactly, inverted.
Yeah, okay. What's interesting is, with this very bearish prognosis that you're telling me, we also understand you are bullish oil. That doesn't really, that only sort of half makes sense, because if you're looking for a recession, that means demand has come off, but if you're bullish oil, that has to mean that supply, there's going to be a big problem there. Where's it going to come from, though?
No, that's a very valuable point, and we've been questioning that from a lot of our investors. However, we think that many other factors are implicating the price of oil, especially demand from developing countries. And we see OPEC making sure that the prices remain high. and as I've said in the beginning of the year, we see Iran and the geopolitical tensions being a big factor. Now we're going to see Mr. Ahmadinejad going to New York, at least applied for a visa, and to speak in front of the UN. And we think that he's going to have a tough talk. And that could also being a big factor. Now we're going to see Mr. Ahmadinejad going to New York, at least applied for a visa, and to speak in front of the UN. And we think that he's going to have a tough talk. And that could also affect the markets, actually, the oil markets on short term.
In other words, you think Iran is going to be forced to play the oil card then at some stage?
Well, I don't know if they're forced to, but I think they would like to. And I think they've been provoking the Western world for quite some time, and it looks like they're keeping that track.
Okay, so to round it all up, third quarter, trim in Fed funds down to 5 even. Oil, your bullish targets end of the year? We're at about 60 now.
Well, I think that in the beginning of the year we had a technical point of view, and we said it would rally, or it would be trading between 55 to 70. Yeah. We think that it will remain, in case that the economy is as it is right now, without any geopolitical tensions, it would be between 55 to 70. However, should we see some problems, we could easily see seeing it soar to 80.
To 80? Goodness, by
end of the year, but that all depends on the factor of the Middle Eastern tensions.
Interesting stuff. And real quickly, gold, you got a view on that? You like it? You continue to like it?
We'll continue to like it. We liked it in the beginning of the year. We like it now. And we believe that the price of gold, which remains inversely correlated to the US dollars, will keep soaring. We expect that the widening of the interest rates between the US and the rest of the world will keep implying a trend weakening on the US dollars. So we'll see more central banks and investors shifting from US treasuries and US dollars to gold.
Interesting stuff. So you got central bank diversification into the yellow metal. You've got this inverse correlation, dollar gold back in sync, as it were. How much of it is also going to be a flight to safety and quality?
You meaning how much they're going to do it in terms of because they think gold is...
how much of the upside in gold is going to be because of flight to safety and quality?
Well, we think that by the end of the year we could see gold at 750.
750. Yeah. It's not really that far. Where are we now? About 625, 630 or so?
No, a little higher.
Yeah. Interesting stuff. So, I mean, look, you're a hedge fund. Put it all together for us. Given everything you've said, recession, rate cut, third quarter U.S., oil bullish. If, Iran gets pushed to it, maybe 80 by the end of the year, a barrel. You continue to like gold. So as a hedge fund, what are you doing?
No, well, I mean, we are a fund of funds, so we don't take big positions, so there wouldn't be any concerns of a blow-up as we saw in Amaranth last year. Okay. We have lowered our exposure to long-short equity managers, mainly because of the reason that long-shorts tend to be more long than short. We have exposed more assets to market neutrals and global macro funds.
Okay, what about paper? What about CDOs? That's usually a big thing for hedge funds.
Yes, well, as I said, since we are fund of fund, we lower our exposure to bond managers.
All right. Okay, Niku, gotta go. Very interesting to talk to you. Thanks for dropping by this morning.
It was a pleasure, Martin.
All right.
Thank you.
Niku Hirachi there, Managing Director of K1, a hedge funds company managing around $500 million US here in our studios. All right, so catch up with the Tokyo market. We're about 15 minutes into trade there. Kari, how's it looking?
Looks fairly firm this morning, Martin, extending the rally that started yesterday, and looks like some of the